Good afternoon. Welcome back to Money Control's live stream. You're watching Closing Bell with me, Lovisha, Darad, and joining me, my colleague Yatin, Mota. Well, Yatin, quite a choppy session. It feels like the markets moved in the same tandem as we did yesterday. We saw that the Sensex and Nifty did recover more than 0.5% from day's lows, but still succumbed and ended in the negative territory. Sensex is below that 76,000 mark, and Nifty is also about 5 points below that 22,950 mark. If we look at the broader end of the markets, that also mid caps ended flat, whereas small caps also faced the larger heat, down more than 1% in today's trade. India Wix, however, which had spiked up to 16 level, that saw a noticeable cool off to 15 odd levels. And among sectors, what stood out well was definitely the IT pack, which stood out well in this volatile market, and we can see that Nifty IT index has posted about nearly 1% gain in today's trade. On the other hand, if you look at consumer durables, autos, the PSU banking pack, all of them fell the most in today's trading session. Yet then, looks like FIs continue to remain cautious on the markets. We were expecting that the dollar weakening or even the yields going back below that 4.5% mark could bring back some FI flows, but still it feels like the India's valuations remain a sore point for them.
Valuations also, and probably the kind of flows we are looking at China and other emerging markets. India always commanded a better premium to all of these emerging markets or other MSCI countries, but probably those funds are probably reversing. Despite the RBI intervention on the dollar, also we have seen a gush of capital outflows which is happening. The reason why probably the Indian rupee is also weakening. But 22,800 that continues to remain a psychological support for the markets. We have been bouncing from those levels continuously. Obviously the market depth was slightly weaker today, but overall it was a stable day for trade with most of the large caps clearly be having a stable day.
Yeah, that's right. Like you mentioned, 22,800 as a key support level. We'll see whether it will stay defiant right now. But coming to some of the top Nifty gainers at this point of time, we have NTPC, which is dominating the chart. 3% gains coming in for the stock after it plans to invest about $62 billion in nuclear power expansion. The second stock, of course, that is your Tech Mahindra, 2.4% gains coming in for Tech Mahindra after CLSA has shared and issued an outperform rating on the stock, and they believe that the company will achieve the FY27 targets and revenue growth above its peers. So an optimistic note coming in from the CLSA. We can see another IT stock, which is Wipro, which also exhibited some resilience, and of course 2% gain coming in from Wipro too. Power Grid also dominated the stock, dominated the chart, and has given about nearly 1.5% gain after it secured order for establishing a substation in Karnataka. On the other hand, if you look at some of the top losers on the Nifty 50, IndusInd Bank, 2% cut coming in for the lender after, yesterday also we saw a little bit of pop in the stock, but today the gains have fizzled out. Some profit booking could be taking place. Some of the consumer names which did not do well, which is your Trent, Britannia, 1.5% cut coming in from there. Ultratech Cement down and dominating the charts. M&M continues to see the slide with about 1% cut, and of course Bharti Electronics. But yes, mid cap and small caps, definitely small caps did come under a majority of pressure compared to what mid caps had shown. Yatin, what do you make of it from that pack?
Of mixed returns for them. In fact, if you look at the top reactions today to numbers, Gillette witnessed a 10% move. Some recovery in stocks like NLC India, which were battered down, 9% up for that stock. Adani Wilmar also making a comeback, almost 8% higher for that stock. Glaxo continues to rally, and the stock has delivered returns of nearly 30% in the last 2-3 trading sessions. That saw a gain of 8%. Stocks like Swan Energy, Carborundum Universal, PTC, all of those stocks continue to hit fresh 52-week lows or are down more than 5%. So the pressure on selective mid cap continues in trade today.
All right. Now let's break down some of the stocks that did grab the limelight. Well, the first stock in focus, that is definitely your Bharti Airtel. The stock did wipe off its opening gains, and it went down as much as 2% in today's trade from its highs. Now, this came after its promoter, Indian Continent, sold around 0.8% stake via large block deal, and the transaction is amounting to around 8,400 crore rupees. Now, this block deal also comes after Bharti Telecom's recent acquisition of an additional 1.2% stake in Airtel in November last year. With this, Bharti Telecom holds about 40% stake in Airtel. Even for third quarter, if we see, Bharti Airtel did post an impressive Q3 performance. We did see a multifold jump in its profit amid its one-time gain from the IndusInd consolidation. But even if we exclude the one-time gain, profit did more than double in the third quarter too. And even revenue also jumped about 9% year on year. Brokerages have also been positive on the counter, and they believe that the FY25 and 27 could be better for Bharti Airtel too. But Yatin, now that the promoter has sold off quite a sizable stake, 0.8% stake, despite the strong Q3 performance, do you believe that the stock could have peaked here from right now, or what do you see visible on the counter?
So two things, in March of 24, Singtel, one of the foreign promoters of Bharti Airtel sold 0.8% stake, and at that time GQG had been buying shares. Today ICIL, which is the Mittal family, promoter arm, they sold nearly 0.8% stake for almost 8,000 crores. There have been speculation in the market that a lot of domestic funds have bought the shares, and mostly the proceeds would be used for their insurance venture Bharti AXA. Partly to fund the balance, partly paid up shares of Bharti Airtel. Remember a few years back that come out with the rights issue of partly paid up shares, and also to fund their acquisition of stake increase in British Telecom in Europe. So there are multiple plans of the promoter entities to invest in other assets, or to continue to fund other growth projects. Markets probably would see it that way, instead of promoter monetizing stake at 52-week highs, or when the stock was doing well, company was doing well. So they'll get that benefit of doubt. Don't think so that the stock will probably peak out or fall from current levels. If the market stabilizes, stocks like Bharti Airtel would surely recover after this particular block deal.
Okay, all right. Let's move on to the second stock in focus for today. That was your ABB India. Well, the stock also erased its intraday gains and ended about lower today, 5% off its day's highs. Now, this came after the cautiousness crept in after the management guided for some growth moderation. They said that the growth could moderate before the next growth cycle starts in their analyst con call. The company also said that it continues to remain positive about expansion in India, and three things, which is your consumption, investment and premiumization, are the three key factors that they will be keeping on their radar for this year. Also, their order backlog is providing some good visibility for the next year. About 60 to 65% orders will be executed this year itself. Now, how the company fared in Q3, it did post a good set of numbers, 56% jump in net profit, while 22% jump year on year on revenue. And on the operating level also, the company's EBITDA zoomed about 57% year on year, and margins expanded sharply by 440 basis points. So with today's fall, the stock is now down for the fourth straight day and has already declined by about 6% during the course of these days. Yatin, if we look at the stock, there was plenty of nervousness which crept in after the management's cautious commentary. Even the technical analyst that I spoke to today morning, he said that investors could remain on the sidelines given their 1:1 risk to reward ratio. What do you make sense of the stock?
If you look at the company, overall the commentary of the management for the coming quarter is slightly slower. In the case of Siemens India also, we've seen that the orders are slowing. Same is the case with ABB. The orders are slowing. Probably markets, which have given a very superior price to earning multiple for all of these MNC capital goods stocks, that premium has evaporated. In fact, on the valuation front, a lot of domestic brokerage is also not comfortable holding shares of Siemens as well as ABB. So what has eventually happened is that with private capex slowing down, a few segment orders slowing down, the margins could moderate, earnings could moderate. Probably the kind of premium these companies got in terms of valuation is now started evaporating, and precisely the reason why stocks like ABB as well as Siemens have seen such a large profit taking. In fact, after a 4% gap up, shares of ABB have fallen intraday, so some profit taking at higher levels. But moving from capital goods to healthcare, and UBS today has come out with an upgrade note on Max Healthcare. Their target has been now raised to 1200. Now, Max Healthcare operates quality hospital chains in North India particularly. And if you look at the company, they have a very aggressive plan to generate nearly 8,000 crores in operating cash flows, in FY25 to FY28 period. UBS believes that the kind of bed addition plan the company has, along with good cash flow projections, the company would require a better valuation multiple. In fact, rich valuations would probably take the stock higher, according to UBS. They say that the company has an impressive track record on occupancy ramp up and breaking even their hospital with their asset light model. So overall, in a scenario where the market is suffering, typically healthcare stroke pharma stocks do well, and probably Max Healthcare is one stock which is on the brokerage radar. After the correction, especially, brokerages are feeling that the stock could be attractive at the current market price.
That's right. After this UBS upgrade, we also have a stock which is in focus, that is your Persistent Systems. The stock did break past its 6-day losing streak, and JP Morgan has issued an overweight call on the stock and has urged investors to buy this dip amid the recent correction. They have given out a price target of about 7,200 rupees, and the brokerage firm forecasts an upside potential of about 30%. They believe that this is a high quality growth compounder, that's what they're calling it, and they expect about 21% revenue and 29% PAT compounded annual growth rate over FY25 to 27. They expect that the record high deals would drive some of the high teens revenue growth in FY26. Persistent Systems too has set about a $5 billion revenue target by FY31, which implies a strong 26% CAGR over FY27 to 31. Yatin, the company has also registered good Q3 numbers, and now this optimism from JP Morgan looks like some good days ahead for the stock, and given the entire sizzle that the IT basket has been experiencing, the stock could benefit from the mid-cap space.
Probably yes, and the correction that has happened in a few of these mid-cap IT stocks after a lot of domestic funds have been selling their, holding. Persistent is one company which has consistently given growth. Most importantly, on the valuation front, we have seen some moderation happening. Probably JP Morgan, has a very good IT analyst team, and after the recommendation, the stock has moved clearly on the higher side for the trade today. But time will tell probably how is the scenario in the US markets, because with the Trump administration taking over, with trade tariffs, what kind of uncertain environment is created in the shorter term is something that we'll be watching out for. But as of now, it seems that brokerages are slightly overweight on a few of these mid-cap IT stocks after they have some promising, growth prospects along with valuations which have seen a downward revision.
That's right. All right, so with that, we have come to an end of this edition of the Closing Bell. Today, the US markets will resume trading after a day's hiatus, so we'll watch out what the global cues have to say. But for now, it's a wrap from Yatin and me. Thank you for watching.